Well, Stephen Nash joins us now from FIIG Securities to try and explain a few of these measures for us in a little more detail. Stephen, thank you so much for coming on the program. Just firstly, people watching would have seen the Treasurer Wayne Swan talking about how banks, credit unions, building societies are going to be able to issue covered bonds for the first time. Can you just explain for us what is a covered bond?
Well, a covered bond is a little bit different from a normal RMBS security, where a normal RMBS security goes off the balance sheet of the institution, whereas a covered bond stays on. And there's a pool of assets that are identified that, in a case of default, the purchaser or investor can either go to those pool of assets or the issuer. So they've got two forms of security. So it's a typically very highly rated security. It's very big. It's been very big in Europe for a long time, and a lot of global banks have this facility to be able to issue covered bonds. So I suppose Australian institutions have had some disadvantage in terms of they haven't been able to get access to that.
And just quickly, I mean, obviously with residential mortgage-backed securities, so they're different to covered bonds because they do go off the balance sheet, this packaging up of the loan assets.
Yes, it's been, that market's been quite active for a long time, but the covered bond has been, they've been prevented from issuing those because of concerns about whether the covered bondholders have some priority over the depositors. And I imagine that opening up a small percentage, allowing the banks to do a small percentage, is a good start, and it will increase the diversity of funding of the banks. So that means that some investors are probably full-on banks and that they can't buy any more. A covered bond might come out and that would allow them to buy some of those. So that would mean that the banks have to fund less offshore and then they have less costs. It may bring the cost of funding down slightly, but I can't see it being a major impact on funding.
And just looking at this, I mean, would you expect it would be the major banks mostly that would be issuing these covered bonds, or could you see all of those lenders, or like including the credit unions and building societies?
Look, initially I'd imagine the major banks will probably do some, and then we'll see how it goes. It's all very new, so I'd imagine, the major users at the moment will be, well, initially will be the major banks, and then followed by the smaller institutions, and we'll get some pricing going, and once the major banks establish the market, they'll be spread off those issues and those sort of things.
So investors looking at this then wondering, okay,
what's in it for me?
Yeah, what kind of investor do you think a covered bond would suit?
Look, I think it's probably going to go to the institutional or the wholesale market initially.
So more kind of the big super funds, that sort of thing?
Yeah, I imagine that will be, because these spreads will be quite low, because they'll be very highly rated. So you won't get, what I mean by spread is interest rate relative to the reference rate. So the spread will be quite low, so the interest rate will be low, and people will probably say, well, the interest rate is not attractive enough for me.
So it wouldn't be for retail investors?
No, for retail investors, there's been some recent retail issues. One is Healthscope recently coming over 11%. I mean, that's very attractive. Also the CBA issue. So yeah, they've been, I suppose, more targeted to the retail market.
Yeah. And it was interesting because the Treasurer also, they're announcing those measures, or asking Treasury to try and reduce the red tape to increase that corporate bonds market in Australia. I mean, has that really been holding it back? Because our corporate bond market is a lot smaller, isn't it, than say in the US?
Well, yeah. Well, I mean, we haven't got a quantum of funds the same as the US for a start. However, typically our asset allocation is much more equity biased than a lot of other countries, so I think there's an issue about cost. Now, what we'd like to see is the cost of issuance for issuers to access bond issuance drop, particularly to retail investors. So we want to be able to connect those investors with issuers without going through too much costs. Maybe it would make sense to drop the prospectus requirements for very large companies, possibly the top 200, so that they can issue on a cheap basis into the retail market and then generate interest. I think there's also issues regarding taxation. Taxation is very equity friendly and not bond friendly. There has been some addressing of that in the recent budget, but it really hasn't been enough, and I think people need to get a bit of tax neutrality between the asset classes. So when I look at those equities, I'm really looking at the underlying risks. I'm not being blinded by the tax benefits that I get from equity investment. Maybe there'll be some more neutrality of taxation in those asset classes. I think that's a really important point.
Have you been seeing an increase in interest, though, from retail investors in corporate bonds with these recent issues?
Definitely the recent issues, there has been a lot of interest in these issues. I think the CBA issue in particular has really kicked it off in a big way. We expect there will be more major bank issues in the retail market next year. It's not going to be initially a large source of their funding, but over time it will build, and it will, again, add to the diversity of funding for the banks. So retail bond funding, another aspect of diversity, covered bonds, another aspect of diversity, and possibly these RMBS securities on a fixed rate basis, as we've been looking at, another source of diversity. It's very important that the banks access a diversity of funding for any potential future problems.
So could you see some of those smaller lenders then issue bonds then with reduced red tape, perhaps more retail investor interest, given if the tax issues are sorted out?
It's not really red tape. It's a lot of the documents that have to be issued are really costly to produce and take a lot of board time. We've got to reduce that amount of time and cost. We've got to connect retail investors with issuers and thereby effectively bypass the banking system totally, so that the borrowers go directly to the retail investors. What's happening, I think, with the regulators is that they're very much equity focused and not really bond market focused, and I think this is slowly changing. We've already seen some improvements in the regulatory style that's been in terms of RG213 and other pronouncements by ASIC. But there's more to be done, and I think it's happening behind the scenes. You've seen it with the recent budget, with that incentive for bond investors versus equities. I think there's going to be more.
And just quickly, government bonds are going to be allowed to be traded for the first time on an exchange. Just what will this do? Do you think there'll be a lot of interest from retail investors in this, or will it be more institutions?
Well, I think the exchange has been very interested in getting CGS on the exchange, and they're very much supportive of the idea, and they think it will really ignite the retail market. We, however, think that they're possibly a little bit low in the yield side, and that retail investors may invest in. Hopefully, they'll buy them. I mean, there's a great argument for them to buy those very secure assets. But typically, we find retail investors looking for more yield, things like CBA or HealthScope or something like that. However, look, it's another change. It's just one more change, and it's good.
And I just quickly, last question about, obviously we've seen this extra money spent on the government investing in these residential mortgage-backed securities, again, adding that extra $4 billion, but also accelerating the development of a bullet bond structure for RMBS. Just what is a bullet RMBS?
It sounds a bit technical, doesn't it? Typically, the RMBS are paid in an annuity format. You know, you pay off your mortgage, you pay a bit of principal, a bit of interest, and that is basically passed through to the bondholder. What these bullet securities do is hold up those payments and pay you all at once. So you have a fixed rate security, and typically, if they can't guarantee payment on that date, they step up. There's a step up that you get, and you get a fairly quickly retiring bond after that. But it's typically fixed rate, so that once it becomes fixed rate, it goes into the various indices, and that makes it much more easily to compare to other issues in the market. Now, these RMBS issues are quite cheap right now, so when they go into the index, people will see them, particularly wholesale investors, and they'll be purchasing them. One of the problems with RMBS is that it doesn't really fit anywhere in terms of the major indices, and a lot of investors have to get special approval to purchase them. But going into the index makes it a lot easier.
So could you see this taking off then?
I think it's not going to be it's not going to solve the problem for the RMBS market. I think it will be very useful, and some of the longer tranches, I think it'll help a lot. So another innovation which is going to improve the markets generally. I think the RMBS market will benefit next year with that.
All right, Stephen, it's been great to get that explanation of what is sometimes complicated for some investors to work through. Thank you very much for that. Stephen Nash there from